Friends, good morning everyone. Now it's time for your accounts class, and you know that from your management accounting book my today's topic ratio analysis. So for this, first of all, what are the learning objectives? Number 1, meaning of ratios and accounting ratios. Understand the uses and limitations of accounting ratio. Understand the meaning and application of liquidity ratio or short-term financial position ratios. Understand the meaning and application of solvency or long-term financial position ratio. Understand the meaning and application of activity or turnover ratio. Understand the meaning and application of profitability ratio. Apply the various ratios in solving the problems in real life situation. So these all are the main objectives of this chapter. And this chapter is divided into 4 parts. Have a look. Liquidity ratio, solvency ratio, activity ratio, and profitability. My today's topic, liquidity ratio. Okay, so first of all, know about the meaning of ratio. If a student gets 80 marks, we cannot say whether he is good or bad. So here 80 marks, absolute figure you are having, but for comparison you don't have any relative figure. On the other hand, if the same student gets 80 marks out of 100 marks, we can say that he is a good student with the 80% marks. Now see the difference. In previous case, one absolute figure you are having 80 marks, but in the second one, 2 relative figures you are having. Okay, out of 180 means 80%. At the end, as a result, you can say that he is a good student. You have might observed in the above examples that an absolute single figure does not help us in making a decision. Okay, for you it is quite difficult to take the decision with this single figure. 2 figures helps us in making a comparison and then make a decision. You can take decision very quickly after comparison. If suppose out of 100 just 40%, just 40 marks, it means you can take corrective measures to increase the level of performance of the student. The same is true with the performance of the companies. If a company earns rupees 40 crores of the profits, we cannot say whether the performance of the company is good or bad. So if you are just having 40 crore profits, you are unable to know about the performance. What is the exact performance, good or bad? Because it is an absolute figure. Okay, like suppose you are having if the data of last 2 years, then you can compare the company's performance very easily. Like in previous years, just 25 crore profits, now 40 crore. You can compare. Now here performance improved. We have to compare its performance either with other companies or with its own performance in the previous years. So for comparison, at least 2 years data required. Intercompany comparison. So what is intercompany comparison? Have a look. 2 companies, Tata Motors and Reliance, used for benchmark the performance against the competitors. We both are the competitors. See the ratios. Gross profit margin of Tata Motors 12.53% this year, and Reliance Industry in loss 9.60. Likewise, in case of current ratio of Tata Motors 0.46 and Reliance 0.37. Now you can compare easily the performance of the competitors just with the help of the ratios. Ratio analysis are tools for comparison. You can compare comparative performance. You can compare the one firm's performance with the another one. The ratio cannot be developed with an absolute figure. Yes, you are unable You are unable to know about the performance if you are having only one absolute figure. At least two figures required. Relative. Real life situation. In a class 50 students, there are 20 girls and 40 boys. So see, total number of students in the class 50 students, 20 girls and 30 boys. We can say that the ratio of girls to boys is 2:3. Yes, it is quite easier. Yes, 2:3 means 2 for the girls and 3 for the boys. In the terms of percentage, we can say that girls are 40% out of 100. 20 and 30. 20 girls and 30 boys, and you, with the help of the data given, find out the percentage. So 40%. And the third situation, the same fact can also be stated as that the girls are 2/5 part of the class. So ratio, the proportion expressed in three ways. See, proportion like 2:3, percentage like 40%, and fraction like 2 divided by 3, 2/5. Okay. So ratio can be expressed in the proportion also, in the percentage also, and in the fraction also. So ratio analysis, main four parts: liquidity, solvency, profitability, and activity. First of all, my today's topic, liquidity ratio. Liquidity ratio can be classified into two parts: current ratio and liquid ratio. So for this, what is liquid? Liquid means a substance that flows freely, means easily you can convert. Liquidity ratio means how quickly you can dispose your assets and get your hands on your cash. Means how easily you can convert your asset into cash form, considered under the liquid ratio. Solvency ratio. First of all, know about the meaning of solvency. Solvency is the ability of the company to meet its long-term financial obligation. In liquid ratio, we just consider short-term financial obligation, short-term liabilities, but in solvency, long-term financial obligations. Whether the business is able to pay its long-term liabilities or not. So, solvency ratio further divided into four parts: debt equity ratio, proprietary ratio, total asset to debt ratio, interest coverage ratio. After this, the third part, activity ratio. First of all, know about the meaning of the activity ratio. Activity ratio measures the how quickly a business can turn its assets into cash. You can find out the answer of the question, how quickly a business can run its asset into cash form or sales, just with the help of activity ratio. It is considered as the indicator to know about the performance. Management and accounting departments can use several activity ratios to know their business efficiency. Have a look. Number 1, under the activity ratio, inventory turnover ratio, trade receivable or known as debtors turnover ratio, trade payables, creditor turnover ratio, and the fourth one is working capital turnover ratio. So the fourth section of ratio analysis, profitability ratio. Know about the profitability. With the help of the profitability ratio, the management is able to judge the effectiveness of the various decisions takes by them. So from the name it is clear, profitability, it's all about the profits. Firstly, know about the profits of the company, then after considering all the facts, management can take the decision for future with the help of the profitability ratio. Under the profitability ratio, see gross profit ratio, net profit ratio, operating ratio, operating profit ratio, earning per share, price earning ratio, return on investment, ROI. Okay, these all are the ratios under the profitability ratio. But my today's topic all about the liquid ratio. First of all, know the key terms: assets, current liabilities, accounts payable, accounts receivable, inventory, liquidity ratio, solvency, activity ratio. So first of all, assets. For example, simply all the fixed and current assets, you know very well in +1 full-fledged chapter about the assets as cash, notes and accounts receivable, securities, goodwill, machinery, land, van, computers considered under the assets. Main head. Assets, the total resources of the person or the business to conduct a business. Current assets. So further, assets divided into two parts, you know very well: current assets and fixed assets. These all the terms for your revision part. For example, cash, bank, cash equivalents, debtors, trade receivables, stock in trade, inventory, prepaid liabilities, accrued but not received. So simply, what is the meaning of current assets? Means you can be able to liquid the asset into cash form within the period of 1 year. Okay, asset that a company or a business has that is the equivalent of cash or can be liquidated in the cash in the period of a year is considered a current assets. Easily, if you convert your asset, realize your asset within 1 year, then it is to be considered as the current asset. Otherwise, it is fixed asset. Next one is current liability. Example, have a look. Income taxes payable, interest payable, bank account overdrafts, accrued expenses, dividends declared, short-term loans, etc. So current liabilities are a company's debts or obligation that are due to within 1 year. If you are able to pay your liabilities within a 1 year, then it is to be considered as current liability. Otherwise, it is to be considered as the fixed liability of the company. So the next term, accounts payable. Accounts payable is your liability to pay someone. Okay, when you purchase raw material, you pay for the power, fuel purchase for manufacturing companies. So accounts payable is an accounting entry that represents a company's obligation to pay off a short-term debt to its creditor or suppliers. Like suppose if you purchase the raw material on credit base, now here your liability to pay the amount to the creditor, to the supplier. Next term, accounts receivable, means someone pays you the amount which is due. Sales of goods, if on credit base, supply of service, money, lending, industry, sale of magazine. Account receivable usually current assets that arise from the selling the merchandise or providing the services to the customers on credit. So if you are providing your services, in return the customer or the consumer provides you the money. Likewise, if you sold the products, that in return you receive the money. So these all items considered under the accounts receivable. Inventory means raw material, the stock available in the godowns. For example, the bakery's finished bread, a completed house constructed by a home builder. Inventory is the term for the goods available for sale and raw materials used to produce the goods available for sale. So raw material, work in progress and finished product stored if in the godowns considered as the inventory or the stock of the company. And the main head for inventory, current assets. So uses of accounting ratios. Number 1, management. Management can use the ratios to judge its own performance and in future take the decision with the help of the ratios available. Shareholders, the real owners of the company, you know that very well because these shareholders invested the money in the company. See the company's progress. If the company earning huge profits, then they all are expecting huge dividends from the company. Okay, they observe the ratio between the profit and the investments. The next user, creditors. Yes, creditors knowing the ability of the company with the help of the different ratios available in the company. Higher ratio between the current assets and current liabilities will make them happy because here it means that your current assets more as compared to your current liabilities. If higher, then all the creditors feels happy. If not satisfactory, means not higher ratio, then they all are in worry. Why? The reason for them, it is quite difficult to receive the pending amount from the company. Investors. Investor may be interested to know the relationship between the interest paid by the company and the profits. Investors means the person who invested the money, okay, in return the interest only company provides if in the company huge profits available. So these all are the users: management, shareholder, creditors and investors. Okay, if the company is earning higher and higher profits every year, they are assured they will get their interest in time. Yes, investor, if the company earning huge profits, then no worry, all the investor will get their interest in time. So what are the limitations of ratio analysis? Number 1, limited uses of single ratio. Number 2, personal biasness. Number 3, ignorance, price level changes, because every year price level changes and this ratio not considering the fact ignores the qualitative factors. Number of qualitative factors also available in the company, but in the ratio only the quantitative aspects considered. Window dressing means not accurately each and every element shown. No idea of future happenings. Yes, contingencies arises. False results. Limited comparability. So these all are the limitations. Next one is, how can company management use ratio analysis? Like intercompany comparison. I given you already one example, okay, of the Tata and Reliance. And intra-company comparison, within the company you can compare the department performance with the help of ratio. So my today's main topic, liquidity ratio. And liquidity ratio considers the short-term financial position ratios. In simple terms, liquidity in banks means how quickly you can dispose your assets and get your hands on your cash. Means how quickly you can convert the current assets into cash form. Okay, how quickly you realize your assets. Ratios are used to judge the liquidity of the company. Okay, so liquidity ratio classified as current ratio, liquid ratio. So first of all, the practical part, current ratio. How to find out the current ratio? Firstly, know about the current ratio. In this ratio, the current assets are compared with the current liability. You compare firstly your current assets with the current liabilities. If the total current assets more than the current liability, it is safe for short-term investors. So what is the ideal ratio which is required? 2:1. Okay, in a company 2:1 considered as the ideal ratio or the criteria, benchmark, standard set. Current ratio, the formula for current ratio very important. Okay, How to find out the current ratio, students? Current ratio is equal to current assets divided by current liabilities. So, first of all, have a look on the current assets and current liabilities for practical part. Under the current assets, cash in hand and cash at bank, current investments, advance against salary, interest accrued, sundry debtors. Now, under sundry debtors, less provision for doubtful debts, you know very well, okay? Prepaid expenses, bills receivable, fixed deposit with the bank. These all are the current assets. Now it's time for current liabilities. Income received in advance, provision for tax, short-term loans, sundry creditors, outstanding expenses, bills payable, bank overdraft. Practical problem number 1. From the following balance sheet, calculate the current ratio. So, one balance sheet is provided to you as a statement. You just find out the current ratio. How to find out the current ratio? Firstly, categorize the current assets and current liabilities. So, under the head C, check out current liabilities given to you. Okay. Likewise, the current assets also given to you. How to solve the problem? See. Formula, apply the formula, current assets divided by current liabilities. So first of all, current assets. Number 1, current asset, current investment 40,000. So right here 40,000. Then inventories 40,000. Here 40,000 record. Next trade receivable, again 40,000. Write 40,000 trade receivable, and then next part, cash and bank balance 20,000, record cash and bank balance 20,000, and after this record short-term loans and advances comes under current assets, record short-term loans and advances, and after this other current assets 20,000. So record 20,000 other current assets. Add all the items and total current assets 1,80,000. Now see from the statement, current liabilities, short-term borrowings 20,000, record short-term borrowings 20,000. Likewise, trade payables 30,000, record 30,000 trade payables. Then from the statement, other current liabilities 30,000, record other current liabilities 30,000, and the last short-term provision. Check out. See, short-term provision 20,000. Recorded all the current liabilities. Now add all the current liabilities. So total current liabilities here, student, 1 lakh. Okay, apply it into the formula. 1,80,000 current assets divided by current liabilities 1 lakh. So end result 1.8 ratio 1. Is it satisfactory, students? No, it is not satisfactory because your sentence set your ideal ratio 2:1. Okay. Now it's time for the second practical problem. Missing value. Sometimes some value is not given to you. How to find out? Then in this way, see the statement. From the following particulars, calculate the current assets. Now here no need to find out the current ratio. Just find out the current assets. Okay. The elements available. Working capital 4 lakh. Current liabilities 3 lakh. Solution. Working capital is equal to current assets minus current liabilities. Put the values. Working capital 4 lakh. Okay. Current assets not given to you. Your question here just to find out the current assets minus current liabilities. So current liabilities given to you 3 lakh. Find out the current assets. So here minus 3 lakh. Then that side 4 lakh plus 3 lakh. Total current assets 7 lakh. Your answer. Because here one value missing, current asset. Now you are having current liabilities, current asset, you can easily find out the current ratio if in the question mentioned to find out the current ratio also. Now you can compare very easily the current ratio. See the current ratio of both the companies, 0.46 and 0.37. Tata Motors more and Reliance less. Now the next part, liquid ratio or the quick ratio. The sub part of the main head liquid ratio. You know na, our chapter divided into main heads, 4 main heads: liquid, solvency, activity and profitability. And under liquid, okay, under liquidity ratio, 2 ratios: current ratio and liquid ratio. The term liquid assets means all the current assets except inventory and prepaid expenses. Only one difference, students, here, just in current assets not to consider the inventory and prepaid expenses. Why? The reason behind this is prepaid expenses can never be converted into cash. Yes, it is quite easier to understand. You know that prepaid, once paid in advance, for you it is quite difficult, unable to convert it into cash form. Okay, that's why they are not termed as considered under the current assets. So what is the formula for quick ratio, liquid ratio? Quick assets divided by current liabilities, or all current assets, just deduct the inventories excluding loose tool and spare part minus prepaid expenses divided by the current liabilities. Or the third formula to find out the quick ratio, liquid assets divided by current liabilities. Okay. Practical problem number 3. From the following particulars, calculate quick ratio. Working capital given to you, rupees 2 lakh. Current assets given to you, rupees 5 lakh. Inventory, rupees 1 lakh given to you. Now it's time for solution. So students, you know what is the formula for working capital? Working capital is equal to current assets minus current liabilities. So put the value. Current assets, you are having 5 lakh, and current liabilities, which is not given to you, only working capital 2 lakh given to you. With the help of the working capital and current assets, very easily you just find out the current liabilities. So here your liability 3 lakh. After deducting from the 5 lakh rupees, 2 lakh, 3 lakh with you the current assets. Now after this, quick assets. How to find out the quick assets? Just eliminate inventory. Inventory in the statement already given to you 1 lakh rupees. So deducted 5 lakh minus 1 lakh, 4 lakh. 4 lakh your quick assets. Then current assets already we are having 3 lakh. So 4 lakh divided by 3 lakh, 1.33 ratio 1. Is it satisfactory ratio, students? Yes, it is satisfactory ratio, because for quick or liquid ratio, the standard set 1:1. Now, what is the significance of liquid ratio? The objective of this ratio is to assess the short-term solvency of the company. You can check out the solvency, how solvent the company, how easily the company quickly pays the liability. You can just find out with the help of the liquid ratio. Okay, this ratio is a better test of short-term financial position of the company than current ratio, as it takes into consideration only those assets which are easily and readily converted into cash. You know that in current assets, all the assets considered, all current assets considered, but in liquid asset, inventories and prepaid expenses not considered. It means in liquid ratio only very quick or readily marketable assets considered. Practical problem number 4. Master equation, the main question. From the following balance sheets of Punjab Limited for the year ending March 31st, calculate the current ratio of the year 2015 and 16. So 2 years data given to you, 2015 and 2016. One balance sheet provided to you, company's balance sheet with you, current liabilities given to you, current now assets, non-current and current assets given to you, notes to accounts, full-fledged statement is provided to you. Now it's time for your solution. Okay. Firstly, consider 2015 for solution part. Check out the liabilities and assets, current assets. To find out the current ratio, you know that current assets required and current liabilities required. So firstly, consider 2015 current assets. So inventories 2,50,000, record 2,50,000. Okay. After this, trade receivable 75,000, record 75,000. And after this, record cash and cash equivalent 1,20,000. Record here 1,20,000, and at the end other current assets 5,000. Add up. Now here 4,50,000 total current assets with you. Likewise, check out the current liabilities 1,88,000 and 12,000 trade payables and other current liabilities. So record here 1,88,000 other current liabilities and trade payables. Now one more amount here is 12 lakh considered. Okay. So after considering the current liabilities from the statement, students, time to apply it on the formula. Okay. You know what is the formula for the current ratio? Current assets divided by current liabilities. Okay. So how to apply it on the formula? Current ratio for 2015 is equal to current asset divided by current liabilities 4,50,000, your total current assets, and your total current liabilities 2 lakh. So answer 2.25 ratio 1. Is it satisfactory, students? Yes, it is totally satisfactory ratio because your sender set here your ideal ratio 2:1. Good result of the company in 2015. Now the next year, likewise, just like 2015, check out the 2016. Firstly, current assets. See, inventories 3 lakh, trade receivable 2 lakh, cash and cash equivalent 1,40,000, and other current liabilities 10,000. See, everything recorded here: 3 lakh, 2 lakh, 1,40,000, and 10,000. So total current assets 6,50,000. Likewise, from the statement, find out the current liabilities of this year: 2,85,000 and 15,000. Record. So after recording for the 2016 the current liabilities and current assets, formula again same. Okay, and find out the answer, current ratio, and with you 2.17. So compare 2 years with you, 2015 and 2016, and in 2016 your ratio 2.17, and in 2015 2.25, means 2015 more ratio as compared to 2016. Like, see, conclusion. It is observed on the comparison that the current ratio for both the years is very near the standard current ratio of 2:1. Okay, near, very near means quite satisfactory, good results. But company's performance in the previous year 2015 much better as compared to 2016. The company was in a better position to meet its short-term obligation in the year ending March 31st, 2015 than in the year ending March 31st, 2016. Okay. So now it's time to know about the difference between the current ratio and quick ratio. Reliable. Which ratio is more reliable? Quick ratio is more reliable because here readily marketable assets considered as compared to current ratio. So current ratio does not show the true short-term financial position of the business enterprise, but quick ratio represents the real liquidity position. So, as a result, the ratio is considered more reliable. Which ratio more reliable? Quick ratio. What is the formula for current ratio? Current assets divided by current liabilities. And formula for quick ratio, quick assets divided by current liabilities. Just find out the difference, like in previous current asset, here quick asset. In quick asset, just deduct from the current assets, all the current assets, deduct inventory and prepaid expenses, and as a result your quick assets. Okay, students? So students, the next difference, students, meaning. Okay, in meaning case, the relationship between current assets and current liability is known as the current ratio. But in case of quick ratio, the relationship between the liquid assets and current liability is known as quick ratio. After this, the objective of current ratio is to know whether the firm is in a position to pay its current liability within a year's time or not. Means here in current ratio considered full 1 year, but in the quick ratio, know whether the firm is in a position to pay its current liabilities within a month or immediately. So the difference of time, in current ratio you just consider 1 year. Okay, 1 year. But in case of quick ratio, 1 month or immediately. Now it's time for your homework questions. Number 1. What is accounting ratio? What is ratio analysis? State the forms in which ratio can be expressed. State the limitations of ratio analysis. What level of current ratio is considered satisfactory? What is the importance of current ratio? What is ideal quick ratio? And also solve the practical problem, students. 1 till 26, some number plus related illustration. And students must watch these YouTube videos for more better understanding of the topic. Thank you so much, students.